Ron Siegel Radio, your home and mortgage connection.
You're listening to Ron Siegel's Home and Finance Radio Show, only on Financial News and Talk. Now live in studio, your host, local and national real estate expert and consumer advocate, Ron Siegel.
And hello again. Welcome to Ron Siegel Radio. This is the show with no real boundaries as we discuss current events, financial markets, politics, sports, even poking fun at the rest of the media. This is the show that connects the dots of confusion, delivered by conflicting media reports. We connect the dots so you know the actions you can take, how your family or business can benefit from current events. Most of all, thank you for joining me. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day. We're a very focused show. We only chat about items that affect the roof over your head, your bank account, and anything I feel would benefit you. And let me remind you, if you ever have any home or finance-related questions, I am the consumer advocate looking out for you, and you can reach out to me directly. 800-306-1990, 800-306-1990, or ronsiegelradio.com. Just remember, that's the number you call anytime for assistance. When you call that number, it comes directly to me first. There are operators standing by.
Quiet, numbskulls. I'm broadcasting.
While I do have a great team when it comes to developing a financing plan, a plan to save you money, I personally work with you, even if you don't have any needs today. Save this number in your phone for future reference. 800-306-1990, 800-306-1990. And yes, of course, we're celebrating today. We celebrate every day on Ron Siegel Radio, National Croissant Day. Okay, I can go with croissants. You know, we need a little butter, and there is a place up in Paso Robles. I guess she used to be in Los Osos, but the lady now sold her restaurant, moved over to Paso Robles at a outdoor market. What do they call it? Farmer's market. And she makes fresh apricot jelly or jam. Put that on a nice warm croissant, and you got it made. With some butter, got to put the butter on there. And you know, if you put a side of bacon with it, you just call that breakfast. Can't ask for much more than that, can you? Take a look and see what the markets are doing today. Dow Jones Industrial Average is down 138 points. I'm sorry, it's up 138 points. The S&P 500 is up 16. NASDAQ down 13. Oil's up 30 cents a barrel. And what's driving all of this? Well, I guess we should comment. It is a sad story. Did you unless you don't watch any news, which I know some people do. And Josh, are you on TikTok? Okay, I thought you were. Do you get your news from TikTok? Okay, did they talk anything at all about the airplane crash? Okay, so I'm not there. I go on there every once in a while. I know we post a lot of stuff to TikTok, but yes, I know a lot of the younger folk, and I guess as I get older and older, everyone's younger than me now. They get their news from the alternative media, which I think maybe the alternative media is getting more action than the old media. You know, I did notice the White House, they did in their first press conference with the new press secretary. Josh, you're going to feel old because she's younger than you and me. 27 years old. Ah, man. I mean, man, they took a couple of the chairs that were for the press office, and they're making those into chairs for new media. I wonder, you know, CNN, I guess they can probably get rid of their seat because nobody watches them anyway. MSNBC, hee-haw, I think they're going to be shut down. So they can take their seats and give them to YouTubers and TikTokers. And is Red Note gone now, or Red whatever that was? Is it gone? No, that's still going. Okay, so, and that one there, now be aware. I think it's kind of funny because they're talking about this red note, I think it is, or red note. Okay, Josh says red note. He knows more about this. So this red note, I heard a couple of people when they're talking about getting rid of TikTok, which, by the way, is not a major issue to the parent company of TikTok. ByteDance owns TikTok. And of all the things that ByteDance does, TikTok is about 9% of the company. So if they can't get what they want, will it bother them to shut it down? But probably not. But will it bother Americans if they do shut it down? Yeah, there's a lot of people that make a lot of money on TikTok. So, but I digress. This Red Note, I've heard a few people when they were talking about that when TikTok shut down for that, 8 or 10 hours, they signed up for Red Note. And within minutes of signing up for Red Note, their phones started getting tons and tons of phone calls from unknown numbers. So interesting. Now, I don't know if it's true or not. Josh says it's not true. Okay. So did you sign up for it at that time, Josh? He did, and they didn't call him. But Josh, you put that phony number in there. No, I don't know. I'm just saying that I did see a lot of folks saying that happened to them. It didn't happen to Josh. So maybe it's because you're old, Josh. Maybe they're realizing that now that you've got to that, it must be nice. I'm double his age, and I'm the one saying old. Okay, so but the bottom line is that Big Brother. Now, here's the other part of this that I've found fascinating. Our phones are all listening to us all the time. So the fact that China's collecting the data, okay, China's collecting the data, Apple's collecting the data, Microsoft's collecting the data, Meta is collecting the data. I'm sure that the U.S. government is collecting the data. Everyone's collecting the data. So if you think that you're going to go somewhere and nobody's going to know where you are, you better leave your phone behind. And then you got to look, and there's probably some sort of scanner that you can get on Amazon, who's also collecting your data, that probably has an Apple AirTag scanner to see if there's an AirTag on your car or in your wallet or in your briefcase or whatever. So everybody already has your data. So one more company, one more country to have the data. And we know during the last administration, they just let the hot air balloon fly over the entire country and take pictures of anything they wanted to. So a lot of news out there. We had the big news of the day yesterday in the finance world. I know there's nothing that's going to be bigger and more devastating than the airplane crash over the Potomac. And our hearts go out to those families who are afflicted, that had loved ones on either the military chopper or the American Airlines plane. Like I said, it's 15 years since we've had a crash in the United States. 15 years. So those people that are worried about flying, be aware it is still the safest method of transportation out there. Although, you have a car crash every couple of minutes in our country and people walk away from them. Plane crashes, we don't have them as often, but unfortunately, generally, people don't walk away from those. You're listening to Ron Siegel Radio, discussing your real estate, current events, and the financial markets. When we come back, we're going to talk about the big news of yesterday in the world of finance, and I'm going to foreshadow what's going to probably happen tomorrow in the world of finance. You can reach me anytime. Our off-air number, 800-306-1990, 800-306-1990, or RonSiegelRadio.com, Facebook.com/Ron Siegel Radio. And if you miss any part of our broadcast, Ron Siegel 1 on YouTube. Ron Siegel, the number 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio. Your home and mortgage connection.
As the economy slows, do you know anyone worried about job loss? At Siegel Lending Team, we offer the Home Select Loan. Think of it as a financial superhero cape for homeowners with good income and credit. It not only saves your home, but also throws a life ring to your credit score. Because who needs stress when you can have peace of mind? Let's secure your future with a smile. Visit rsrhomeselect.com. rsrhomeselect.com. NMLS 217037.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. The Mortgage Minute today being brought to you by our friends at Geneva Financial. When you're ready for that next home loan, Geneva's got the programs and the products. You just need to make the call, 800-306-1990, 800-306-1990, and every day at this time, OBMMI. They provide the most comprehensive, accurate, timely, and interactive analysis of pricing ever conducted in the mortgage industry, calculated from actual locked rates, with consumers across 35% of all mortgage transactions nationwide. They don't tell us points paid, points received, or the APR. They tell us the number you need to put into your mortgage calculator to find out what your principal and interest payment will be. If you want that principal and interest payment, well, all you got to do is go to the mobile app, download it onto your device, rsrlinks.com/mobile app, rsrlinks.com/mobile app. What did rates do yesterday? Conventional 30-year fix, 6.88. That was up. Jumbo 30-year fix, 6.873. That was down. FHA 30-year fixed, 6.515. That was up. VA 30-year fixed, 6.368. That was down. USDA 30-year fixed, 6.501. That was down. Those are the rates from yesterday. If you want our market commentary, we put that out each and every business day as early as the market allows or as early as the data allows. All you have to do is go to rsrlinks.com/market update, rsrlink.com/market update. I need Josh to tell me. Market minute, rsrlinks.com/market minute. You think I remember it because I say it every day. rsrlinks.com/market minute. And yesterday we did put that out a little bit later than we like to. And the reason being is we had the Federal Reserve meeting yesterday. So we wanted to get that information out there to our subscribers. So as soon as we got the data from that Federal Reserve meeting, and I'll tell you about that in a minute, the S&P 500, that right now is up 11.81. Let's take a look and see what the 10-year Treasury is down 3 basis points. Mortgage-backed securities are up 4 basis points. The 10-year Treasury, we talk about that. That's what the yield is doing. That's the interest rate that you get paid on that 10-year Treasury right now. The bond is what we talk about when we talk about the mortgage bond. That was up 5 basis points. So when that goes up, interest rates go down. 5 basis points is not very meaningful, so it's not going to have a whole heck of a lot of effect. But let's talk about what the real numbers were. The big important issues from yesterday was the Fed meeting. And the report that came out, 11 o'clock our time, was that they're holding their discount rate steady. And we were very much expected. But then a half hour later is when the fireworks all start. And what do I mean by fireworks? Well, this Fed chairman has decided that every one of the Federal Reserve meetings, after they finish their meetings, they have a press conference. And the chairman comes out, gives a little bit of a speech, and then takes questions for the next hour. A lot of the questions are pretty boring. If you've got no life like me, you listen to them. And then I report on them the next day and give you the synopsis in just a couple of minutes. So they had their 2-day meeting, followed by Jerome Powell press conference. Initially, after the statement, the bond market sold off. Selling off means that the bond goes down, yields go up. Fed statement was more hawkish as they upgraded their language on the labor market and showed a bit more concern over inflation. Here are the changes in the labor market. December 18th, they said, quote, since earlier in the year, labor market conditions have generally eased and the unemployment rate has moved up but remains low, unquote. Yesterday, now remember, they parse every single word from these reports. Yesterday, quote, job gains have moderated since early last year but remain strong, and the unemployment rate has remained low, unquote. Inflation, December 18th, quote, inflation has made progress toward the committee's 2% objective, but remains somewhat elevated, unquote. Yesterday, Quote, inflation has eased over the past year, but remains elevated, unquote. So while the bonds sold off after the statement, Powell walked back many of the comments in his press conference, which helped bonds to recoup all of their losses. He explained that the tweaks in language of the statement on the labor market and inflation should not be interpreted as a signal. After that comment, the bond market recovered. On the labor market, Powell said that it's solid because firing rates have remained low, but he acknowledged that hiring rates have declined sharply. We have been explaining for a long time that the main reason inflation is elevated above the Fed's target is the lagging shelter data. Yesterday, Powell acknowledged this and said that the shelter component has been steadily catching up and is the main reason for the gap between where inflation is today and their goal. This means he also sees inflation coming down further, but because of this, unless we see some other factors that cause inflation to rise. Powell also said that the Fed funds rate is meaningfully above neutral. He also said that the Fed is meaningfully restrictive, meaning that the Fed's policy should still slow down inflation and growth in the U.S., and they have room to cut rates still before getting to neutral. On the QT, quantitative tightening, or the reduction of their balance sheet, Powell explained that bank reserves are still abundant. They will continue reducing the balance sheet, but did not give a timetable on how long it will continue or when it would stop. When it does eventually stop, the Fed will have to reinvest in treasuries, which will absorb some of the supply, helping interest rates go down. The thing there in all of that is that Powell and the Fed get an insight into what the inflation numbers are that are going to come out tomorrow. And had they said that they're still seeing some meaningful benefits, well, then we could have taken that as an assumption that the numbers were going to either be the same or better. But they took that wording out, which leads me to believe that the PCE, the inflation numbers, are going to come in either flat or not as good, meaning inflation is up a little bit. That could be detrimental to the market, and I would say we probably will see interest rates go up tomorrow. Fourth quarter GDP, gross domestic product, which measures U.S. economic growth, rose 2.3% in the fourth quarter of 2024, but the estimates were for 2.6%. Most of the rise came from consumer consumption and government spending. Because this was a miss and lighter than market estimates, it helped bonds to move higher and yields to move lower. Okay, so we're watching that one for you as well. Remember, that is the first reading. We'll get two more, and we'll see what happens on those two more readings. We also are going to look into what caused the numbers, because we know based on tariffs coming, companies were starting to build inventory. So that's pulling growth from future quarters back into a prior quarter, which means that number may be overstated. Initial jobless claims measures individuals filing for unemployment benefits for the very first time, fell 16,000 to 207,000. This does encompass last week, which is a holiday week, and historically they undershoot the number of claims during those weeks. Continuing claims fell 42,000 to 1.86 million. Previous report, however, was revised higher to 1.9, and is the first time we have hit that level in 38 months. Clearly, as the Fed explained, while firings are muted, once you're laid off, it's harder to find a job because hirings have slowed down. And we're going to watch and see what happens in that front, because we did hear the president come out yesterday. It was yesterday or the day before, and said they're offering 2 million government workers an opportunity to take a severance package where they'll still get paid through September and not go to work. And they're expecting 5 to 10% of the people that they offered this to, those 2 million, to accept it. So 5 to 10% of 2 million could be 200,000 government workers, taking an early retirement and sayonara. Now, the real question is, how many of them already said sayonara? Because there are reports, and again, you don't always know whether the reports are accurate, just like Josh shared with us a little bit ago about the number that I was told about this red book or red note, is they're talking about the idea that maybe some of these folks that have had work from home jobs, and we know the productivity is not great on these work from home jobs. Maybe those people aren't really working. Maybe they're doing something else, or maybe they're working, but they have a second job. So we're going to watch all of that for you. You're listening to Ron Siegel Radio, discussing your real estate, current events, and the financial markets. I know, Josh, I'm going a little early here. When we come back, the secret is selling using an agent to get your house noticed. Mortgage Rates 101, Part 5. What causes mortgage rates to change? And we're going to do Part 6 today also, locking in your mortgage rate. And we've got a Borrow Smart segment, part of this workshop. Uninsured drivers, a hint at risk, and how to protect yourself. All that and more. Reach me anytime. Off-air number 800-306-1990. 800-306-1990 or ronsiegelradio.com. Facebook.com/Ron Siegel Radio. And if you miss any part of our broadcast, Ron Siegel 1 on YouTube. Ron Siegel, the number 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio. Your home and mortgage connection.
Confused about the home buying process? Or curious how much you really know about buying a home? Take the First Home IQ quiz to test your understanding of buying a home. Created by the nonprofit First Home IQ, this 5-minute quiz will give you a score, what you missed, and why. Take the quiz in 5 minutes at rsrlinks.com/FHIQ and find out what you need to know about buying your first home. That's rsrlinks.com/FHIQ.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. The real-time real estate segment today being brought to you by rsrmoney.com, rsrmoney.com. The secret is selling using an agent to get your house noticed. Important questions right there. In a most recent survey, the National Association of Realtors, NAR, asked sellers what they want most from a real estate agent. The number one answer was to help market their house. It makes sense. The way your agent markets your house can be the difference between whether or not it stands out and gets attention from buyers. That's why it's so important to work with an agent, an expert local agent that knows what they're doing. According to the same report from NAR, here are some of the most common methods real estate agents to use to market homes and how you benefit when your agent uses them effectively. If you're watching us on ronsiegelradio.tv, any of our socials, or the ABC News and Talk AM 1490 FM 98.1 video feed, you are seeing a chart of the top methods real estate agents use to market homes. Multiple listing service, 86% use that. Yard sign, 61%. Open house, 58%. Real estate agent website, 46%. Social networking, 22%. Virtual tour, 16%. Video, 12%. Listing on the MLS, real estate agents have access to the multiple listing service. It's a database. And that's great for you because having your house on the MLS helps it get more visibility from other agents and buyers. And the more people who see it, the more likely it is to sell. Using a yard sign may seem simple, but it's one of the best ways to catch attention of people driving or walking by. And when it does, they'll help spread the word to friends and family who are looking to buy and that there's a house for sale in the area. It also puts your agent's contact information on display, making it easy for interested buyers to get in touch. Having an open house. An open house is a great way to create a sense of competition and urgency among buyers. And that can lead to stronger offers. And since you'll only need to leave once for many buyers to visit, it makes the process easier for you too. Plus, an open house helps your agent get real-time feedback about what buyers love and what they're not as sold on. Showcasing on your agent's website. Having a house on your agent's website presents it in a professional way, and odds are people visiting your agent's website are serious and ready to make a move. So this is a smart way to get it in front of motivated buyers. You might even want to have it on a website dedicated only to your property. You might want the yard signs to have pictures of your property. Social networking, posting your house on social helps get your house in front of buyers who may not have seen it with traditional marketing. It also makes it easy for people to share your listing with friends and loved ones. Providing virtual tours for buyers who are relocating from out of town, virtual tours allow them to check out your house anytime from wherever they are. This helps reach more potential buyers who may not be able to come to see your house in person. Using video. Video is an excellent way for your agent to show off some of the top features of your house, like your kitchen, large closets, outdoor entertainment areas, and other key details that could attract buyers. Sending emails. Sending out information about your house to your agent's expansive database is another way they'll get in front of even more people. Great agents may even send emails teasing that your house is coming to the market as a way to boost interest and excitement before it officially has an open house. Here's what it comes down to. Most good agents will write a description of your house for the listing and pair it with high quality photos, but a great agent will do so much more than that. They'll not only lean on their expertise, they'll put in the time and effort to make sure your house makes an impression on buyers and ultimately sellers. As a seller, working with creative local real estate agent is a smart way to ensure your house grabs the attention of the right buyers. If you're ready to sell, give me a call, 800-306-1990. We'll even help you get your house on TV. Yes, we do that for every one of the agents we work with. So give us a call and talk about that part as well. That is the Real-Time Real Estate segment, brought to you by rsrmoney.com. rsrmoney.com. Again, go and take a look at rsrmoney.com, and I'm sure you'll get some great information right there about your property's values. Let's take a look. Mortgage 101 from rsrhomeselect.com, rsrhomeselect.com. Let's take a look at this one. We're looking at what causes mortgage rates to change. I like this one. Okay, so mortgage rates change daily and sometimes multiple times per day. In this workshop, mortgage rates, we're going to refer to the combination of upfront cost and actual interest rate described that we in part 2 that we did earlier. For example, if we talk about higher rates, it could either mean that the interest rate is higher or simply that the upfront cost is higher for the same interest rate. These frequent changes are not arbitrary in any way. Instead, they are the result of multiple factors with varying levels of importance and interdependence. Mortgages exist because investors want to earn interest by offering loans. Because of this, mortgage rates end up being directly driven by all the various market forces and operational considerations that dictate what those investors can, should, and must charge. Factors relating to market forces, much like mortgage borrowers need money to buy a home, the U.S. government needs money to finance federal spending. Political commentary aside, this creates a massive market for government debt, which in turn serves as the plainest, most risk-free benchmark for many other types of debt. Collectively, this is known as the bond market. There are many other types of bonds with varying levels of risk and different features. They all exist because investors need or want to lend money, and various entities need or wants to borrow money, and mortgage borrowers are one such entity. When lenders have enough of the same type of loan from mortgage borrowers with similar circumstances, these loans can be grouped together to form a bond that can then be sold to other investors. Once the mortgage lender sells those loans to other investors, they now have the cash flow to go make new loans, assuming there are other investors who are interested in buying more loans. Thus, a market for these mortgage-backed securities, MBS, is born. It's quite a bit more complex in practice, but generally speaking, it's simply a market for groups of loans. These trade on the open market and tend to follow the broader oops, my computer just went slow on me. We're trying to get the information here. the broader movements of more mainstream bonds like U.S. Treasuries. In short, all the factors that can affect interest rates in the bond market can also affect the price that investors are willing to pay for these groups of mortgages. Those prices have a more direct influence on the rates that mortgage lenders can offer than anything else. Bottom line, loans become mortgage-backed securities which trade on the open market, and the prices of mortgage-backed securities dictate the rates that lenders can offer to new mortgage borrowers. So what are the factors relating to operational considerations? Knowing the price that investors are willing to pay for a group of similar mortgages gives lenders a baseline for the costs they must charge. The lender's operational considerations will account for the rest. These considerations are all directly or indirectly related to how much profit the lender wants to make or how much business they are capable of doing. For instance, we tend to think of banks as always being available to make loans to borrowers who fit the right criteria, but that isn't always the case. Many mortgage lenders have a certain amount of cash flow they'd ideally like to use over a certain time frame. If a lender isn't on pace to lend as much as they'd like, they might lower rates in order to entice more business. Conversely, if a lender is on pace to lend out more money than it has, it could raise rates in order to deter business. Apart from the availability of funding, lenders must also consider the availability of personnel. It takes human beings to make loans happen, and at a certain point, a lender will be at capacity. It can then either hire more staff or simply raise rates to throttle the amount of incoming business. There are two of the most basic operational considerations for lenders that complement the actual market-driven prices of mortgages. These can be thought of as sort of business that sells a product made from raw materials. A car company, for example, is greatly affected by the cost of steel and aluminum, but the cost that buyers end up paying is also greatly affected by how that car company does business. How many factories do they have? How well trained are their employees? How efficient are they? In the mortgage world, mortgage-backed securities would be like the steel and aluminum, while individual lenders would be like the auto manufacturers, each trying to build or sell cars as efficiently and as profitably as possible. Let's bring it all together. The lender's specific considerations certainly change and certainly account for a portion of any given mortgage rate offering. Quite simply, this is why different lenders offer loans at different rates, even though they're all working with the same raw materials. But it's those raw materials, like mortgage-backed securities, that move throughout the day and do most to affect the moment-to-moment changes in lenders' interest rates. For something in the world is happening to cause investor demand to increase in bond markets, MBS tend to benefit as well. When MBS prices rise, investors are willing to pay more for those bundles of loans, meaning that lenders may be able to offer lower rates. Conversely, if investors are seeking riskier investments for whatever reason, MBS prices could fall, meaning investors aren't paying as much for mortgages, thus forcing the lenders to raise rates. That is Mortgage 101, brought to you by rsrhomeselect.com, rsrhomeselect.com. We're going to continue this series. There's more to come in it where we keep talking about these different issues, and we'll end up putting all of these together and getting you a bunch of these so you can actually go through all of them at one time. But that's why we educate you on Ron Siegel Radio. You are listening to Ron Siegel Radio, discussing your real estate, current events, and the financial markets. Uninsured drivers, a hidden risk, and how to protect yourself. And locking your mortgage rate. That's our next part of the series. You can reach me anytime. Our off-air number, 800-306-1990. 800-306-1990 or ronsiegelradio.com. Facebook.com/Ron Siegel Radio. And if you miss any part of our broadcast, Ron Siegel 1 on YouTube, Ron Siegel, the number 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio. Your home and mortgage connection.
Confused about the home buying process? Or curious how much you really know about buying a home? Take the First Home IQ quiz to test your understanding of buying a home. Created by the nonprofit First Home IQ, this 5-minute quiz will give you a score, what you missed, and why. Take the quiz in 5 minutes at rsrlinks.com/FHIQ and find out what you need to know about buying your first home. That's rsrlinks.com/FHIQ.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. Borrow Smart segment today being brought to you by rsrhomeselect.com, rsrhomeselect.com. Uninsured drivers, a hidden risk, and how to protect yourself. Picture this. You're driving home from work, minding your own business, when bam, another car slams into yours. Shaken but relieved to be unharmed, you step out to exchange insurance details, only to find out the other driver has no insurance. Now what? This is a reality for 1 in 7 drivers on the road today. According to the Insurance Research Council, 14% of motorists are uninsured, leaving responsible drivers vulnerable to costly accidents and legal headaches. If you're not prepared, you could be left footing the bill for damages that were not your fault. So how can you protect yourself and your finances? Let's break it down. Understanding the risk, uninsured versus underinsured drivers. First, let's clarify the difference. Uninsured motorists, they call that UM. This is someone who has no auto insurance at all. If they cause an accident, they won't be able to pay for your damages, leaving you to cover the costs. Underinsured motorist, that would be a UIM. This is a driver who has insurance, but not enough to cover all damages. If their coverage limits are too low, you may end up paying the difference. The financial impact of an accident with an uninsured or underinsured driver can be devastating, especially if you suffer serious injuries or property damage. No fault versus tort states what it means for you. Where you live plays a big role in how insurance claims are handled. No fault states each driver's insurance pays for their own damages, regardless of who caused the accident. While this helps avoid long legal battles, it also means you might have limited options for recovering costs if an uninsured driver is involved. Tort states, fault is assigned to one or both drivers, and their insurance companies pay accordingly. But if the at-fault driver has no insurance, you could be left without compensation for their share of the damages. Regardless of your state's laws, you need protection against uninsured and underinsured drivers because their financial irresponsibility should not cost you thousands of dollars. How to protect yourself from uninsured drivers? The good news, you have options. Many states require drivers to carry uninsured motorist and underinsured motorist coverage, but even if it's optional where you live, adding this protection to your auto insurance is a smart financial move. What this coverage does: bodily injury coverage covers medical expenses, lost wages, and pain and suffering if you're injured by an uninsured or underinsured driver. Property damage coverage pays for repairs or replacement of your vehicle if the other driver doesn't have enough coverage or any at all. Hit and run protection. If an insured driver flees the scene without leaving information, this coverage can help pay for damages. So how do you get covered? Number one, check your current policy. Many drivers assume they're covered, but not all policies insured UM or UIM protection. Review your coverage with your agent and know those terms, UM/UIM. That's the way it's going to show up on your policy. Number two, know your state's requirements. Some states make UM/UIM coverage mandatory, while others leave it optional. Even if it's not required, it's worth having. Number three, consider your risk factors. If you live in an area with a high rate of uninsured drivers, or if you drive frequently, extra coverage is a wise investment. Number four, compare costs versus potential losses. UM/UIM coverage is usually affordable, and considering the tens of thousands of dollars an accident can cost, it's a small price to pay for peace of mind. Final thoughts: don't wait until it's too late. An accident with an uninsured driver can happen anytime, anywhere. And when it does, the last thing you want is to be left paying out of pocket for someone else's mistakes. Protect yourself, your family, and your finances by making sure you have the right insurance coverage in place. Need help navigating your auto insurance, debt management, or financial strategy? I'm here to help as a Certified Liability Advisor, CLA. I specialize in helping families build wealth through strategic debt management and financial protection strategies. Give me a call so you can drive with confidence knowing you're protected. And as I've shared many times, I don't sell the insurance, but I know the people that do. If you are one of those insurance people, give me a call at 800-306-1990, 800-306-1990. We're always looking for people that can help the listeners of Ron Siegel Radio for a better, strategically better financial future. Again, that is the Borrow Smart segment brought to you by rsrhomeselect.com, rsrhomeselect.com. I think we got time for another Borrow Smart segment. Borrow Smart, Mortgage 101. That's Mortgage 101, brought to you by rsrhomeselect.com. Mortgage 101 brought to you by rsrhomeselect.com. Best loan on the market. If you don't know about it, you can get all the details, rsrhomeselect.com. Mortgage Rates 101, Part 6, locking in your mortgage. And obviously, all the other parts of this program are available to you. All you got to do is just go to our website. We will have all of them. Mortgage Rates 101, Part 6, locking your mortgage rate. At some point during the mortgage process, the contract interest rate, the one that ends up on the promissory note, the most official document stipulating the terms of repayment, must be locked. This means that there is an agreement between the borrower and the lender regarding what the contract rate will be. The rate lock will specify a date by which the mortgage must be closed and funded. Lock timeframes. Rate lock timeframes can vary historically. The most common timeframe had been 30 days. The regulatory changes of the post-meltdown era caused slightly longer turn times for the various steps in the mortgage process, resulting in an increased prevalence of 45 and 60-day lock times. There continue to be shorter and longer lock time frames as well, depending on the lender. These include, but not limited to, 10, 15, 21, and 90 days. In some scenarios, or among certain lenders, the borrower doesn't have any input as to when and for how long the rate will be locked. The borrower may either agree to the lender's lock policy or take their business elsewhere. In most cases, however, there is a certain degree of liberty when it comes to choosing when and for how long to lock. In these cases, mortgage originators will help manage expectations as to how quickly the process can be completed, with the generally understood goal being to set a lock window that leaves plenty of time for the loan to fund, but that isn't unnecessarily long. Cost considerations. Why wouldn't we want a lock? Why wouldn't we want a lock time frame that's unnecessarily long? Bottom line, the longer the lock window, the higher the cost. When it comes to the mortgage process, costs associated with your rate lock can take the form of changes to the rate itself or changes to the upfront cost, discount, or rebate associated with that rate. Locking in the same rate for longer means that the discount will be higher or the rebate will be lower. The relationship between days of lock time and cost isn't always exactly linear, so it can make sense to weigh the risk and reward of various timeframes. When to lock? There's no universally correct answer to the question, should I lock or float? It's one of the most thought-provoking and complex topics in the world of mortgage origination. There are many variables for one methodology to be applicable to every scenario. It goes without saying that locking as early in the process as possible will always be the safest option for the borrower. It's also unequivocally true that it's historically the least profitable option on the average day from 1980 on. That said, this is only the case because interest rates have generally been moving lower since 1980. Not only that, but there have also been many times since 1980 where rates have been risen brutally in spite of longer term trends. In many of those cases, I lose something here? In many of those cases, borrowers that failed to lock early enough in the process were either forced to accept a higher rate or simply never complete the process. Purchase and refi lock considerations. When we talked about never completing the process, this could naturally be a very big problem in some cases. For example, rates can rise quickly enough that many borrowers can no longer qualify for the monthly payment. If they're not locked, they simply cannot complete the mortgage. In the case of purchases, that could mean they lost their earnest money deposit, not to mention the opportunity to buy the house they wanted or needed. Even in the case of refinances, failing to complete the mortgage can mean the loss of significant monthly savings, or in more dire cases, much needed cash for any number of properties. Because of these potential pitfalls, it's almost universally wise to heavily consider locking as soon as the monthly payment and lock time frame makes sense for your scenario, and to only forego locking if you're prepared for the increased costs associated with an unforeseen rise in rates. If such a rate rise would jeopardize your qualification for the mortgage or even your willingness to complete it, locking is the only option. Lock extensions and expirations. Despite the best intentions and diligent participation among all properties, some mortgages are destined to run past their initial lock time frame. While there is no universal policy, most lenders are able to extend the lock time frame on certain conditions. Most of the time, this will involve a predetermined cost. And in many cases, this is simply the difference in cost between your original lock time frame and the next tier. For example, if there was a 0.125% change in the discount points in order to lock for 60 days instead of 45, and assuming you locked for 45 days only to find it wasn't going to be long enough, near the end of the process, extending the 60-day lock could be as simple as adding that eighth to your upfront costs in order to extend the lock for 15 days. In other cases, depending on the lender, the situation can be far more severe, especially if rates have moved significantly higher since you first locked. It can be absolutely the case that going over the originally agreed upon lock time frame means that your loan will now have worst case pricing. This means that you have to pay whichever is higher between the original cost of the lock time frame needed to complete the loan or the current mark rate. If we're only talking about something like an eighth from the previous example, that's not a big deal. But if rates had moved significantly higher, that could increase easily be over 1%, enough to make anyone wish they'd chosen the longer lock window up front. So there you have it. That is part 6 of Mortgage Rates 101, locking your mortgage rate. And that's brought to you by rsrhomeselect.com, rsrhomeselect.com. Once again, it is the best loan on the market. Saves you a lot of interest dollars, saves you a lot of time on repaying the loan. If you don't know anything about it, most people don't. It's an offset loan with a sweep function. Go to rsrhomeselect.com, rsrhomeselect.com, and learn about the loan. And as always, we ask, set that first radio preset button to come back here and join Ron Siegel Radio, where we only speak about items affecting your house and your bank account. Thanks to all of our sponsors. Big thanks to Josh and Sean for engineering us today. And of course, a special thanks to you for spending a little bit of your day with us. That's all for Ron Siegel Radio. Again, if you have any questions or to meet any of our guests, call me anytime, 800-306-1990, 800-306-1990, or ronsiegelradio.com, facebook.com/Ron Siegel Radio. And if you miss any part of our broadcast, Ron Siegel 1 on YouTube, Ron Siegel, the numeral 1 on YouTube. Stay tuned. We'll be back in just, we'll see you next week.